Welcome to Breaking News to Trading Moves. I'm your host, and today we're looking at a story that has just completely rocked the IT services world. It is a messy situation. We're talking about Kyndryl Holdings.
It really is a complex one. And, when things get this messy for one company, it almost always creates a very specific set of opportunities and risks for everyone else.
Exactly. And that's our goal here. We're not just here to gossip about, what went wrong, though we'll definitely cover that. We're here to look at the market mechanics. When a big player like this stumbles, that capital, it doesn't just vanish, it moves.
It has to go somewhere.
So we want to identify the winners and the losers that come out of this news.
Right. You have to look past the emotion of the headline and just follow the logic of the capital flow.
Okay, so let's start with the headline itself. Kyndryl Holdings.
Yeah.
The ticker is KD. Their stock has taken an absolute beating after a disclosure that, well, it had pretty much everything you don't want to see.
It was a very, very difficult press release for them to put out. I mean, you've got an accounting review, key leadership leaving, SEC inquiries.
It feels like the trifecta of bad news, really.
It is. And for anyone listening, it's really important to get why this specific combination of news is just so toxic for a stock price.
Okay, so walk us through it. What are the facts? What exactly went down at Kyndryl?
So Kyndryl, again, that's KYOD, they disclosed a few critical things all at once. First, you have a leadership departure. The chief financial officer is out.
Right. And a CFO leaving on its own can be nothing.
But exactly. In isolation, you can manage it. People move on. But this was not in isolation. It came alongside an announcement that they're delaying their quarterly filings. They also talked about an internal review of their controls and disclosures, and they specifically called out cash management practices.
Oof. Cash management.
Yeah. And if that wasn't enough, they also mentioned they'd received voluntary document requests from the SEC.
Wow. That's a lot to unload in one go. And I want to be clear here, because we all hear about earnings misses all the time. A company's revenue's off by 1% or whatever. This isn't that, is it?
No, this is a completely different category. Look, investors can handle a miss. A deal slips, the economy was a bit slow, you can model that. You put it in a spreadsheet, maybe you adjust your target down 5%. But what Kyndryl announced, it strikes at the core of credibility.
It's the uncertainty of it all.
Precisely. When you mix a top finance exec leaving with delayed filings and an internal review, you're basically telling the market, we are 100% sure our numbers are correct.
Right.
And then you throw the SEC on top of that, the risk profile just explodes.
And it wasn't just the governance side, right? The business itself was also showing weakness.
Yes, that's a key point. Buried in all this was the fact that results and guidance were also weaker than expected. And they said they expect to report material weaknesses in internal controls. So you've got a business that's underperforming, wrapped inside a crisis of confidence.
Which explains why the valuation just collapsed. It's not just that they earned less money. It's that the whole timeline for fixing the company is now a giant question mark.
That's it, exactly. Kyndryl was pitched as a turnaround story. You buy into a turnaround because you believe in a timeline. This news just shreds that timeline. It introduces what we call event risk, the fear that, the other shoe is about to drop.
And investors don't stick around for that.
They sell first. They ask questions later.
Okay, so that sets the stage. KD is at the center of this storm. But like we said, money moves. So if people are fleeing Kyndryl or customers are getting nervous, that's got to benefit someone else. Let's talk about the winners.
Let's do it.
The first category seems pretty intuitive, a flight to safety. I mean, if I'm a CIO at a big company and I see these headlines about my vendor, what am I thinking?
You're thinking about one thing, risk. You have to remember, these are not small contracts. They run the backbone of Fortune 500 companies. A CIO can't afford to have a service provider that's distracted by legal battles or internal chaos. They need stability.
You want someone boring and reliable.
You want a fortress. And this is where your large-cap IT consulting and outsourcing firms step in. When a competitor like Kyndryl shows any sign of instability, enterprises start shifting work, or at least future work, to the vendors they see as the most trusted.
So who are the names that pop up there?
The two primary beneficiaries are likely Accenture and IBM. Accenture is ticker ACN.
ACN. And why them specifically?
Well, Accenture is really seen as the gold standard for low-risk execution. They might be expensive, but they are perceived as incredibly stable. So if a board member asks the CIO, hey, are we exposed to this Kyndryl mess? The easiest, safest answer for that CIO is no, we're with Accenture.
It's the old nobody gets fired for hiring IBM argument.
Right, but for the modern consulting world. And speaking of IBM, ticker IBM, they benefit too.
Which is a bit ironic, of course, since Kyndryl was spun out of IBM to begin with.
It is ironic, but IBM still has that reputation. They have the scale, they have the balance sheet that just screams safety. For a client worried about vendor stability, IBM looks like a very safe harbor right now.
Okay, so that's the big picture consulting. What about the actual nuts and bolts, the infrastructure services?
That's our second category of winners. If Kyndryl has to pause or gets distracted from bidding on new work, or worse, if clients get nervous and start to rebid existing contracts, that work has to go somewhere.
The servers don't manage themselves.
They do not. The work doesn't disappear, it just gets redistributed. So you look for other players with global scale who can step in and take over.
Yeah, who are we looking at there?
Two key names come to mind. First is Cognizant, ticker CPSH. The second would be HCL Technologies, which trades as an ADR under HCLTECH.
Cognizant CTSH. How do they fit in?
They compete directly with Kyndryl across a lot of these infrastructure and maintenance deals. You can bet that if Kyndryl is paralyzed, Cognizant sales teams are on the phone with those clients immediately. They can pitch themselves as the stable alternative.
We're focused on you, not our internal investigations.
That's the pitch. And it's a similar story for HCL. They are a massive provider, deep expertise in infrastructure. When contracts come up for renewal, credibility is a huge factor. If Kyndryl's is damaged, HCL is right there to pick up the business.
That's a tough business.
It is. Corporate procurement departments do not like risk.
Now, there's a third group of winners that I find really compelling. It's a bit more of a second-order effect. You've labeled it governance and compliance.
Yes, this is about the reaction. When a story breaks about material weaknesses and SEC requests, it sends a chill down the spine of every audit committee member at every other public company.
Right. Everyone immediately goes and checks their own front door is locked.
Precisely. Directors turn to their own CFOs and say, could this happen here? Our control's tight. And that fear directly drives demand for tools and services that ensure compliance.
So in a strange way, bad news for Kyndryl acts like an advertisement for companies that sell security and compliance products.
It absolutely validates the budget for that area.
So what tickers should we watch in that space?
You're looking at leaders in IT security, risk, and compliance. Specifically, I'd point to Fortinet, that's FTNT, and Palo Alto Networks, PANW.
Okay, Fortinet, FTNT. Break that down for me.
Fortinet is cybersecurity, but a huge part of cybersecurity is about visibility and control, knowing who's accessing your critical systems. When internal controls are questioned anywhere, the solution is often more automation, stricter controls. That's a direct tailwind for Fortinet.
And Palo Alto Networks, PANW, same idea.
Same basic logic. They're a leader in enterprise security, and while the Kyndryl issue is about accounting, the bigger thing here is governance failure. Palo Alto sells the platforms that CIOs use to prove to their boards that they have governance over their entire digital operation. They benefit from that corporate anxiety.
So to recap the winners,
Yeah.
we have the safe harbors like ACN and IBM. We have the direct competitors who can pick up work like CTSH and HCL. And then the anxiety plays like FTNT and PANW.
That's a great summary of the winner's bracket.
All right, now we have to flip the coin. Let's talk about the losers. Obviously, Kyndryl, KD, is the biggest loser. But they're not the only ones hurt by this.
No, not at all. In the market, guilt by association is a very real thing.
Let's start there. Your first category for losers is turnaround IT services.
Right. So investors, they tend to group companies into mental buckets to simplify things. One of those buckets is legacy tech turnarounds.
And if one company in that bucket suddenly looks toxic,
The market just assumes the whole bucket might be spoiled. If Kyndryl, a classic turnaround story, suddenly reveals its numbers are shaky and its turnaround is in jeopardy, investors look at other companies in that same bucket and they de-risk.
and who else is in that bucket with them?
The most prominent name that gets caught in the crossfire here is DXC Technology, ticker DXC.
DXC. And let's be very clear, DXC did not announce anything wrong with their accounting.
No, they absolutely did not. And that's the frustrating part if you're a shareholder there. DXC could be executing perfectly, but because they share characteristics with Kyndryl legacy services, a turnaround story investors sell DXC in sympathy. They just get spooked.
This sell now, ask questions later mentality strikes again.
It does. It puts pressure on DXC's management to really prove they are not Kyndryl.
Okay, next category of losers. You've called it discretionary spend and fragility. This seems to be about projects that are maybe not mission critical.
That's a good way to put it. This bucket includes the mid-tier IT services firms, companies like EPM Systems, which is EPAM, and Globant, ticker GLOB.
Why do they get hit? They seem so different from Kyndryl. They do all the new modern digital work.
They're very different. But think about the logic here. When a giant like Kyndryl has this kind of turmoil, it makes the whole IT spending environment feel chaotic. And if you're a CIO dealing with vendor risk and budget uncertainty, what's the first thing you put on hold?
The nice-to-haves, the new projects.
Exactly. You pause the digital transformation work, you delay the new app. EPM and Globant are heavily exposed to that discretionary spend. You can't delay running your mainframe, but you can delay building the future.
So, in a weird way, the boring infrastructure work is safer right now than the high-growth digital work.
In this specific climate of fear, yes. If CIOs tap the brakes, EPAM and GLOB are the ones who feel it first.
And your last category here is high-leverage, weaker balance sheets. This just sounds like basic financial health.
It is. When negative sentiment hits a sector, the market becomes really unforgiving of any perceived financial weakness.
Who are the companies that fall into that group?
Here we're looking at companies like BGSF, ticker BGSF, and Korn Ferry, which is KFY.
Korn Ferry, KFY, that's a staffing firm, right?
It is. And BGSF is also in that workforce solutions space. The connection is pretty direct. If the Kyndryl news signals a broader slowdown or just general chaos in the sector, companies pull back on hiring. They stop using external staffing firms.
So KFY gets hit because the people pipeline slows down.
Right. And for any company with a weaker balance sheet or more debt, any threat to their cash flow gets magnified. Investors look at a firm like BGSF and they think if the sector slows down, their debt could become a real problem. So they sell. It's a flight from any kind of risk.
It's just amazing how one bad press release can send these shockwaves across so many different types of businesses.
It's a whole ecosystem. Nothing happens in a vacuum.
So let's wrap this up. We have the headline, Kyndryl KD is in trouble. We have the winners, the safe harbors like ACN and IBM, the direct competitors like CTSH, and the compliance plays like PANW.
And then the losers. The sympathy sells like DXC, the discretionary spend plays like EPAM, and the financially weaker names like KFY.
For someone watching this unfold, what are the specific things to keep an eye on with Kyndryl? What's on the watch list?
I'd say there are 4 key things. First is timing. When do they actually file this delayed report? The longer it takes, the worse the market will assume the problem is.
Silence is not your friend here.
Silence is terrifying. Second is scope. Does this accounting review get bigger? Right now it's about cash management. If they come back and say it's also about revenue recognition, the stock has a lot further to fall.
Yeah, that would be a disaster.
Third, customers. Watch for any signs of deal slowdowns. If a major client publicly drops Kyndryl, that turns a financial problem into a core business problem.
And for fourth,
the guidance reset. At some point, they have to come out and give a new baseline. Even if the numbers are much lower, the market needs certainty. If they can stabilize expectations, the stock can find a bottom. Until then, it's tough.
It really brings up a final thought, for me at least, about corporate trust. We talk about numbers and margins, but at the end of the day, a stock price is really a measure of trust.
It absolutely is.
And once that trust is questioned, especially on internal controls, which is really just a fancy way of saying we check our own work, how long does it take to win that back?
Years. A very long time.
It feels like it takes so much longer to rebuild the reputation than it does to fix the actual accounting error.
The spreadsheet fix is the easy part. Recovering the trust. That's the hardest asset to get back.
Well, that is where we are going to leave it. A really clear look at the mechanics of a market stumble. Thanks for listening to Breaking News to Trading Moves.
Please note that this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
We'll see you next time.